Hello and welcome to another video on how to secure yourself financially. So in today's video, I'm gonna focus is on the financial statement ratios and calculations, right? So just to make a quick recap over the entire section, okay, that the SEC, the Security Exchange Commissions, describe that if you're able to read nutritional labels or mm, baseball box score, Jesus. You can also learn to read uh, financial statement, and if you can know how to apply for a loan or follow a recipe, you can learn the basic of accounting, and the basic they are difficult. So in this section, its focus is on the basic understanding of how to read financial statement, much like the CPR class and course teach you how to perform basic cardiopulmonary resuscitation, but they won't train you to be a cardiac doctor. Much like these sections, it won't train you to be an accountant, but it can give you some confidence when you're able to see a set of financial statement and make sense of them. So after all, this financial statement show you the money. That's what it is. And you have four types of them. Balance sheets that show what a company owns and what it owes at a fixed point in time. The TLDR, or the True Audited Read, is it's a snapshot of the company assets, liabilities, and shareholders' equity, where assets are anything that a company owns that has value, whether it's tangible or intangible. Liabilities are obligations that a company has to pay, and shareholders' equity, which represents the amount of money that owners, uh, or in this case, the creator of the company, has purchased on the company common stocks, plus or minus revenue or losses since inception. So it represents how much money the company or how much money will left over to the shareholders if a company decides to sell off all of its assets and pay off all its liabilities. So in the balance sheets, we have several layouts or way of how you can visualize that. But after all, they follow is the same formula. The assets are equal to the liabilities plus shareholders' equity. So with this formula, most of the time you will find, for example, in yahoofinance.com, uh, distribute like all the assets listed on the top, where generally it will list it based on how quickly they can be converted into cash. So you have current assets, so assets that a company expect to convert into cash within a year, as well as, so for example, inventory, non-current assets, so they will take longer than a year to convert into cash, and fixed assets, assets that are not for sale because it allows your business to run, period. Equipment, property, plant, that kind of thing. And also, I look at the liabilities. So these are obligations, and it's generally listed based on their due date. So you have current liabilities, obligations that a company has to pay within a year, and long-term liabilities, as well as the shareholders' equity, which here is when sorry. So is the amount of owner invest in the company stock plus or minus. Sorry. So is the amount of owner invest uh, in the company stocks plus or minus revenue since inception. And sometimes company distribute this earning and they call that dividends. So this is balance sheets. Then I look at the second financial statement, which is the income statement, that it shows how much a company spend or make to produce their good or service. So the bottom line of this statement shows you that, and you can think of this as a set of stairs that you start at the top with a total amount of revenue, and once you go down one step at a time, you make a deduction associated with that revenue. So broadly speaking, you start with the total amount of revenue. Once you go one step down the stair, you deduct things like merchandise returns or discounts to reach to the net revenue. Then going down, you deduct things like the cost of sales, among other expense. The cost of sale is, well, how much it costs for that company to produce a good and service over a period of time. And then once you deduct that, you reach to the gross profit. Going down the stair, you deduct things like amortizations and depreciation, as well as operating expense, so expense that a company incur to maintain its day-to-day activities. Okay, such as administrative salaries, marketing, or research and development. So once you deduct that, then you reach to the operating profit before interest and income taxes. So interests are, well, activities that a company incur for lending or borrowing that can earn some interest, whether it's on the money market funds, by certificate of deposit, or on any other financial instrument that allow to earn incomes or pay in the case of asking for a loan. So once you deduct that, you reach now to the operating profit before income taxes. And this is money that you have to pay to the government, the income taxes. And at the bottom of the statement, the bottom line, well, you see if a company is able to make money or not, right? And also there is something called the EPS, the earning per share, which is hypothetically the amount of money. Yeah, this is hypothetically, right? Earning per share. This calculation tells you how much money the shareholders will receive if, or how much money the shareholders will receive for each share stock if the company distribute all of its net income for the period. Which is, of course, company don't do that; they reinvest that in their company. But this is an hypothetical calculation, earning per share. Okay, so if a company decide to distribute all of its net income for the period to the shareholders, that will be the hypothetically money that will receive. And then I look at the third financial statement, which is cash flow, which report the company's inflow and outflow of cash. And this is very important because much like persons, company need to have cash on hand to pay this expense or purchase assets. So the bottom line of this show the net increase or decrease in cash. And if we use information from the balance sheets and the income statement, and the cash flow statements review the cash from one of these activities, the operating activities, investing and financing. So operating activities involved is in analyzing the net income from the income statement and then conciliate with the total amount of cash that was used or perceived from operating activities. The most common operating activities can be break down into operating assets and liabilities, where on the operating assets you have things like inventory, property, plant, and equipment, prepay expense, expense that a company incurred for goods or service that that will be received in the long run. For example, premium insurance, home, vehicle, car, liabilities, disabilities, long-term care, uh, such as nurse healthcare or home healthcare, life in the event of the policyholder's death, intangible assets such as patents, copyrights, trade secrets, trademarks, goodwill, as well as customer relationships, investment in affiliates such as joint ventures like Post Malone and Crocs, where it's a partnership between two or more companies that decide to undertake specific business activity. Okay, uh, where each member receives a common share of the joint venture. Get that? Uh, Equity investment, which is a company invests primarily in. It is pretty fucked up. It's pretty funny because, for example, BlackRock and Vanguard, you know, BlackRock and Vanguard, which are investment advisors. Vanguard's an investment advisors, an investment company, BlackRock. So, in the equity investment, which is part of the most common operating assets, so here is when a company uh, decide to buy another company stocks to gain some influence, but not for total full control over the allegedly, but not total control over the uh, companies. But it can influence that into the another company management. So it can raise its voice on the board of directors and influence their and influence their the another company management's operations. So, for example, you have equity investments like Berkshire Hathaway, led by Warren Buffett, as well as which invest in a variety of industry, such as an energy, healthcare, retail. Also, you have SoftBank, which is a Japanese conglomerate that invests primarily in uh, technology companies such as WeWork, Uber, Lyft, Alphabet, which is a parent Google company that invests in technology companies primarily through their venture capital arm called Google Ventures. Also, you have um, Texas Pacific Group, Texas Pacific or TPG, which is a private equity firm. Is this? Which is a private equity firm, Texas Pacific Group, which is a private equity firm that invests primarily in uh, different sectors like real estate, healthcare. Also, Uh, you have things like associates, where a particularly ownership or a particularly investor or company may have around to 20 to 50% of the company's shares. Also, you have limited partnerships. When a company invests in a limited partnership in return of some of the assets in limited partnership operations. Another common operating activity is the cash and cash equivalents, such as money market funds, where now this involved in the purchase of large volumes of very short-term debt financial instrument, such as certificate of deposit. So short-term, how do you say that? So yeah, certificate of deposit. Um, Jesus, certificate of deposit. Uh, Certificate of saving or a saving certificate issued by banks with short-term maturity, certificate of deposit, bank acceptance, which is issued very short-term debt issued by banks, repo, which is securities issued with short-term maturity, as well as commercial paper, which is short-term debt from corporations. It's risky short-term debt, as well as the U.S. Treasury, which are uh, short-term debt from governments. So this is just in the case of the most common operating activities, right? And most of the time they use money market fund is to park money until they decide to move on. So they are not suitable for a long-term investment. And then I look at the common operating liabilities, okay, such as accrue expense, accounts receivable, accounts payable. Uh, and accrue expense are any expense that a company incurred for good and service that has been received but not yet paid for, such as rent, administering salaries, utility bills, taxes. Deferred revenue, which are obligations that a company has to provide good and service in the future, such as subscription service like Netflix or Spotify. And recently now Twitter, now renamed as or rebrand as X, as well as the uh, um, as well as the Jesus um, uh, gift cards, which is another pre another deferred revenue. Okay. Also, I look at income taxes, which are obligations that a company have to pay taxes to the government, whether it is local, state, federal, or foreign. It can be vary. So, for example, in the U.S., it's something around 21%, but again, that can vary by country. Withholding taxes, which is the tax that your employee, if you had in a relationship like that, your employee deduct from your gross wage salaries, gross wage, and pay it back to the government. This is to promote the pay as you earn tax system. Now, with that, I also look at the sales taxes, which are imposed on certain good and service, such as the VAT, value added tax, which is a special tax imposed uh, uh, along the from the uh, mass manufacturing to distribution of at each phase of the supply chain. This is a tax imposed along that supply chain, where each business that belongs to that remit that portion, that tax to the that portion to the tax, and the customer ultimately pay the full VAT for that. So I also look at excise taxes, which is the special tax imposed on things like uh, guns, tobacco, alcohol, gasoline. Short-term borrowing is another type of common operating liabilities, whether it's from banks or line of credit, perhaps trade borrowings, or when you ask for your suppliers and vendors, as well as for an individual, outstanding invoice. So based on that, you're going to ask money for that. Uh, um, as well as mm, okay. Uh, as well as payroll advance for your employees. Another common liability is uh, notes payable, uh, where now is an agreement between the borrower and the lender uh, that outline all the condition of a loan, whether it's the interest, the repayment schedules, the amount borrower. So you have, for example, banks, business, uh, credits or trade credits, or trades payable, individuals. So also look at the warranties or obligations that a company has to provide a good and service, uh, and to fix or replace a defective good or service, such as software warranties, parts, vehicles, manufacturing warranties, you name it. So with this two, with this overview of these two type of operating activities, assets and liabilities. Okay, now I gain a more broad perspective and sense when it comes to apply that to my business, and how important is for me to ask loans or ask long-term loans here, uh, to purchase for certain good and assets that will make me much more efficient with my time and with my business. So okay, so with that, uh, this is just the first part of the cash flow. Okay, this is just the first part of the cash flow. So if you want to take a look at here, the Yahoo here, from Coca-Cola here. Okay, so the second part of the cash flow is the investing operations. So this generally involve is the purchase or sale of long-term assets. Long-term assets such as intangible assets, property, plant and equipment, investment, leasehold improvement. Okay, and then I look at the financing activities where this focus is on how a company is raising funds to pay through or to pay its investors through capital markets. Because this section helps investors to see how a company is raising funds, how often, and where the money came from. So if a company is constantly raising funds from taking out of debt or issuing equity or debt, that might not be a good sign of investment. However, if a company comes, the cash flow of a company comes from it is operating, the vast majority of that comes from that, that might be or that is a good sign of an investment. However, the devil is on the details. Okay, this is something that Investopedia describes. So this financial investment or this financing operation focus is on how a company is raising funds from investors and creditors, how they repay the debt and share dividends to the shareholders. And most of the time, this involved is or example of this are in issuing equity. Okay, so when a company goes public, it does that. Issuing equity, issuing debt. Perhaps the company wants to issue some financial debt instruments such as debentures, notes payables, or as debentures, notes payables, or how do you call it? Tra- bonds, uh, repaying debt, repurchasing stocks, leasing, which is a contract or an agreement between two companies where one company allowed another the right to use a particular asset, an equipment, plant, property, without taking ownership on that. And this world will becoming a land of leasing. You know, this world will become a land of leasing. Totally, totally. So okay, so that's the cash flow, and then I also saw something called the footnotes, which is very very important. It packed with some informations such as significant uh, accounting policies and practice. Okay, so companies are required to disclose accounting policy and practice. For example, if they follow is the GAAP, the generally accounting accepted principle, or the international reporting financial statement, international reporting financial statement. I think it is international financial reporting standards. Okay, international financial reporting standards. Uh, income taxes, where now it broke down into be more specific about the federal, state, local, and foreign, pension, and any other post-retirement programs, the cost of these programs, as well as how well are funded, if they are over or underfunded, and stock options, which are uh, financial instruments that allow the user or the owner the right but not the obligation to purchase an asset at a given upfront price. So, for example, okay, company issue this kind of financial instruments to employers in the hopes that a more better future, right? So all your allegedly all the hard work that you're doing today will be reward in the future. So you have two types of uh, stock options. You have puts and calls. So puts are bets that the stock will fall, and calls are bet that the stock will rise. Okay, and this is a form of equity derivative, or uh, meaning that the underlying of the stock options value relies on an underlying assets, whether it's an assets or a group of assets or a benchmark. So then I look at the MDA, which is the management discussion and analysis of financial conditions of and result of operations, a long-term name to describe from the management eye important trends that have shaped the company past and reasonably likely will shape the company's future. So the this gives an opportunity to investors to see that, right? So when I look at the 10Q, which is the form that companies fail to show this kind of information, the MDNA, you can see data relevant about what are the important trends, the risks that have shaped this company, uh, as well as for example, more macro economics perspective when it comes to look at how all of these companies, in the case of Apple or Amazon, how they are getting their main source of revenue. Most of the time it's from the US or Canada. Uh, and this is something very, very important because it can give you an insight of of the financial condition and results of operations. So right now, here, after all of that, uh, I'm looking at the financial statement ratios and calculations, which are tools that are used for investors to evaluate a company. Okay, so as a general rule, desirable ratios vary by industry. Something very important. Okay, as a general rule, desirables ratios vary by industry. So, industry such as energy, real estate, healthcare, retail, among others. Okay, interesting. So if I ask ChatGPT about this, okay, so show me industry market, show me a critical industry market for a country. Certainly, I can help you identify critical market for a country. However, I will need to be more specific. Ah, okay. USA. Technology and innovation, finance and banking, healthcare and pharmaceuticals, energy and natural resource, manufacturing, agriculture, entertainment and media, aerospace and defense, automotive, retail, construction and real estate, tourists. Interesting. Interesting. Very, very interesting. But there is nothing remotely close to infrastructure. Ah, well, construction and real estate. Ah, okay, is enrolled in the infrastructure development and housing and tourists. The U.S. attract millions of international tourists each year, contributing to the economy through hospitality, travel, and related industries. Okay, interesting. But this is according to um, the ChatGPT from 2021 data, September 2021. The United States has a diverse and robust economy with several critical industry markets that significantly contribute to its GDP, gross domestic product. A way to measure is the wealth of a nation by how much a country spend, which is weird and thought. It's like anyway. Here are some of the key critical industry markets in the United States: technology and innovations, finance and banking, healthcare and pharmaceuticals, energy and natural resources, manufacturing, agriculture, entertainment and media, aerospace and defense, automotive, retail, constructions and real estate, and tourism. So this is our the critical areas or industries that, again, because now I'm looking at the financial ratios, financial statements, ratios, and calculations, informations that investors use to calculate and evaluate a company, that it can vary by industry: technology and innovation, finance and banking, healthcare and pharmaceuticals, energy and natural resources, manufacturing, agriculture, entertainment and media, outer space and defense, automotive, retail, construction and real estate, and tourists. Okay, so with that, that'll be all for this video. Take care. Bye bye.